the subscribe button.
Welcome back to the channel. Today we'll talk about interest rates. When we have interest rate changes, many different things are expected and many different things happen. Rise in interest rates typically results in lower stock market returns and increase in bank lending rates. What I mean by that is lower stock returns mainly because the stock market is no longer the only game in town. So instead of putting all your money in the stock market to get a return on your investment when there's a low interest rate situation, as interest rates go higher, then you have folks taking some of that money that they typically put in the stock market, remove it from the stock market and put it in other instruments. As such, your stock market returns are lower. You also have increase in bank lending rates. As the central bank increases the interest rates that they lend money to the banks then increase the interest rates that they lend to consumers. Also, for many savers, rising interest rates typically mean increase in interest payments on deposit accounts, for example, savings accounts or certificate of deposit accounts. One of the most interesting things to watch is the speed at which interest rates are increased and the speed at which banks increase interest rates on deposit accounts. The speed of rise in interest rates on deposit accounts is typically inverse to the speed at which interest rates are reduced, meaning interest rates on deposit accounts rise slower than the rate at which they're reduced during a low interest rate situation. So banks essentially rises interest rates on deposit accounts slowly and reduces interest rates on deposit accounts very fast once the changes are made by the central bank. The reason for this is very simple. It is the business model of banks. So when you have fallen interest rates, once interest rates are reduced, banks are typically the fastest to reduce interest rates on savings accounts and certificate of deposit accounts. The speed of interest rate change is much slower with regard to the interest rates on loans. The reason for this is quite simple. Banks are able to make money this way. By reducing interest rates on what has to be paid out, in this case, interest rates on deposit accounts, banks are paying out less to consumers or customers while keeping interest rate on loans high. In this case, banks are obtaining funds from the central bank at a low rate, lending the money at a high rate, and paying customers at a low rate. This strategy maximizes gains for banks, and banks remain profitable. In situations where you have rise in interest rates, when interest rates begin to rise, banks are the fastest to raise interest rates on specific instruments. Specifically, banks quickly raise interest rates on loans, but are delayed on raising interest rates for saving and certificate of deposit accounts. Again, this is the business model of banks. Banks obtain money from the central bank at a specific rate. Banks then charge customers on loans more than the rate at which they obtain the money from the central bank and pay out less to customers for certificate of deposit accounts and saving accounts. So let's talk about the general business model. The best business you can be in is one that gains a return no matter what the economic environment. Banks are somewhat in this position. Banks have found a way to gain no matter what the economic situation. Interest rates goes up, banks make profit. Interest rates go down, banks still makes profit based on how they change interest rates on different instruments. This dynamic is not news to anyone who tracks the banking industry. Banks are positioned to benefit from fatter lending margin as the central bank raises interest rates. So what can consumers do? Consumers can also play this game to their advantage. One of the many things that consumers can do as interest rate changes is to borrow or to refinance any loans that they may have when interest rates are low. Knowing that the market operates in cycles, interest rates typically rises when there's a lot of easy money or inflation. As the central bank attempts to restrict inflation, the central bank will increase interest rates. On the other hand, interest rates are reduced if there is a recession or too little money or economic activity. Here, the central bank tries to stimulate economic growth by lowering interest rates and increasing the money supply. Consumers need to pay attention to this cycle and act accordingly. But this leads us to online banks. To take advantage of higher interest rates, consumers should also search for online banks. Online banks typically pay interest rates that are multiples of that of the typical brick and mortar banks. But also, online banks tend to increase interest rates on deposit accounts at a faster rate and to higher levels as compared to brick and mortar banks. But also, consumers should be careful in locking in interest rates with regard to certificate of deposit accounts. When interest rates are rising, when you lock in a rate, you may miss out as interest rate further increases. So as we're in a situation where interest rates are now rising and changing, it is normal to expect lower stock market returns and increase in bank lending rates with regard to bank loans. It is also normal to expect that rising interest rates typically translate into higher interest payments on deposit accounts, for example, savings accounts or certificate of deposit accounts. However, pay careful attention to how fast or how slow banks raise these rates to make themselves more profitable. Play the game and put your money where you will get the better return. This is often referred to as the only free lunch in finance. Increase your returns without increasing your risk. If you like this video, subscribe to the channel.